Hey guys, it's Christina. Welcome to my channel. Since our team's engaging in DeFi world for many years and our program KAKI based on Layer 2 is underdeveloped and perfected, we would like to have a place where I can let more people get to know it. So here we are. If you guys are interested about blockchain and Ethereum and derivative products, you come to the right place definitely. So don't forget to hit the subscribe button and turn on all bell notifications that you won't miss every video posted here. We also have the Twitter account as this picture shows and Medium and Discord which is under construction. All of this in first link, you can find it down below this description. Oh, by the way, before we get started, this is not financial advice and always dependent on your own research. Alright, let's jump into it. Everybody knows the most eye-catching event in financial world in February is a battle between Wallstreetbets and the institutional investors. Need to make it clear that we're not gonna talk about the details of this battle, but the secret weapon used in the battle. Okay, Wallstreetbets primed the pump to long selling on Reddit forum to fight against the short selling from shark investors of Wall Street. And they also encouraged people to post out their return pictures to share with each other. Among those people, a guy who bought $50,000 GME shares had a jaw-dropping return of $40 million. Unbelievable, right? Well, a well-known investment management firm named Melvin Capital almost bankrupted because of short-selling GME shares. At this point, our mysterious weapon come out. It's options. So, what is an option? An option is a sort of right that can be used in the future. After paying for the premium to a seller, buyer will have the right to buy or sell a specific amount of underlying asset at a predetermined price on a given date. For example, the Bitcoin price is $50,000 at present. Alice is a buyer and Bob is a seller. Alice has a perspective that the Bitcoin price is gonna rise up in 1 month. So she buys a call option contract with Bob that if Alice wants to buy 1 Bitcoin at the price of $51,000 after a month, Bob is obliged to sell it. Alice needs to pay $100 as option premium. So if Bitcoin price is gonna rise up to $60,000, then Alice has the right to exercise this option to buy 1 Bitcoin at the price of $51,000. As a seller, Bob has no choice but to sell it. Through this process, Alice makes a net return of $8,900. If Bitcoin price drops to $40,000, Alice can choose to refuse to exercise this option at the cost of $100 option premium. Okay, now we can see that here are some features about buyers in option trading. Firstly, limited losses but infinite gains. The maximum amount lost is option premium, just $100 in Alice's example. But if Bitcoin price rise up high, Alice probably will have a return like dozens of times of premium. Secondly, option is more like put leverage in the trading, but no worry about the margin closeout. In this battle, retail investors can fight against investment sharks through purchasing GME shares directly, but they turn the pivot towards to buy call options from market makers. Now, let's make it clear what is market maker. We all know that there are a lot of exchanges in America and they compete with each other normally. A firm chooses an exchange to make flotation of shares because of the active liquid. So, a market maker in the exchange is responsible to facilitate transactions, helping to keep the marketplace liquid. They may hold a lot of shares and try to make balance between supply and demand by selling or buying stocks according to the market. For example, if buying volume is higher than selling in present market, they sell some shares. On the contrary, they buy in if the selling volume is higher than buying. How can call options result in triggering the rally in this event? Well, when option buying volume is more than selling, there will be buying positions. In order to settle shares, market makers need to use a premium to buy a specific amount of shares to settle the position. Normally, buying position is not very huge, but in this case, because of the encouragement of Wallstreetbets, people bought call options insanely. Thus, the buying position is pretty big. All in all, retail investors can purchase a lot call options, only need to pay for a little premium. But for market makers, they had to purchase a lot real GME shares, finally resulted in the rising up of share price. Right now, you may understand how powerful the options are. In option trading, you could be a buyer or a seller. The feature of a seller is on the contrast of a buyer. Infinite losses and limited gains, and most of the time, gains are the premium. Here you may have a question that who gonna willing to be a seller only earn little premium? Well, tell you the truth, winning rate from a seller is incredibly high, and little premium adds up, that's a lot. If you guys are familiar with Texas Hold'em, you may know that it's important to ensure win rate in every round to make a good return in long term. A little example, if someone buy a call option, seller will win the premium when it's sideways trend or dropping, so winning rate is 2/3. The advantage of a buyer or seller, that depends. Just because of different factors in market, option tradings are quite interesting. Alright, that's it for today. Hit the thumbs up if you like this video. I'll see you next time.